Well, with more than 7,000 banks in the U.S., we could be sitting on the brink of a wave of mergers next year. That is the view of my next guest. He's Keefe, Bruyette Woods research analyst Christopher McGratty. McGratty is the lead analyst on KBW's bank takeover list. And what a list it is pretty long. Before we get into the names, though, you have Toronto Dominion today. Last week we had Bank of Montreal. Are those deals the template of what we're going to see in the next 12 months?
Clearly with these two transactions, we're seeing the Canadians deploy some capital. They've obviously weathered the storm from the economic downturn north of the border down to the United States. So they're deploying some capital to the United States.
Right.
We think in terms of M&A, we're starting to see early signs of an emergence, but it's going to take time.
It's going to take time. Why now? Some might have said, why not sooner?
I think asset prices are firming up, liquidity is improving in the market, and banks have raised a significant amount of capital. So I think all three of those...
They've raised a significant amount of capital.
Correct.
Okay.
So those three factors clearly point to the fact that we're on the road to the recovery.
If you were sitting on a bank board, you were a director, what would you say, or what would you be thinking in order to say whether or not you would stay independent or you would merge?
Yeah, sure. One of the ideas is, can you earn your cost of capital over the cycle? We think there's several earnings pressures that are going to face the industry this cycle, and we think the pressures that are going to be facing the boards are clearly going to drive some of the decisions.
You mean whether they can earn their way to growth?
Whether they can earn an acceptable rate of return for shareholders, and if they can't, whether merging, that may be the best path for shareholders.
Okay, so you have a list, right? Or you've got a couple of lists: the buyers, the sellers, and then the buyers who will become sellers. Is that right? Give me some of the top picks for you.
Sure. We think economics clearly early in the cycle are going to favor the buyers this cycle. If you look last cycle, the economics clearly favored the sellers. So the strategy for investors was to buy the sellers, the banks that they thought were going to be taken over in hopes of a premium. We think early on in this cycle, the economics are going to favor the buyers. So we like the buyers. We like companies like PNC, U.S. Bancorp, who are in a very good position competitively. They don't have to do acquisitions, but they can. We think they're going to do them both on the bank side, but also on the non-bank.
On the non-bank side, like what, for instance?
For a fee income platform, whether it be in the credit space, the processing, businesses that have generate high degrees of capital and are less capital intensive.
What's the top buyer that's going to become a seller for you?
A company that I follow in Chicago is First Midwest. It's an $8 billion bank in Chicago. We think they've made it through this cycle. There's still some headwinds for 2011 related to commercial real estate, but they've raised the capital. We think they're in a strong competitive position. Chicago is one of the most overbanked but most attractive longer-term markets. We think they're a winner over the cycle.
Okay. Where does the FDIC come in all of this?
Sure. We've seen about 325 bank failures to date. We think that's going to continue. That's going to be an emerging trend throughout 2011. I think the economics have started to change in which the buyers, the attractiveness of a distressed acquisition are less than they were initially to induce buyers. But it's the loss sharing agreements have changed. There's more bidders for the same amount of companies. So we think over time banks are going to migrate from FDIC transactions to open bank.
So what does that do to valuations then? Over
the course of the cycle, that will improve valuations for the sellers. But early on, as we've seen two transactions with Marshall & Ilsley and Wilmington Trust in October, they both were taken out of tangible book.
Right.
And comparatively for historical purposes,
a pretty good discount.
That's a pretty good discount to historical. Yep.
Chris, thank you.